challenge for the U.S. is going to be, we're much closer to full capacity right now. The labor markets are very clearly tightening, and wage inflation's picking up. Some of the Bureau of Labor Statistics surveys are showing a remarkable drop in the number of people being fired and a rise in the number of people that are quitting voluntarily. Those are signs of a very healthy labor market. You throw some fiscal stimulus into that kind of environment, and you could get the kind of wage inflation dynamics that the Fed might not like. I'm also sensitive to what kind of fiscal stimulus. If it's direct fiscal stimulus on infrastructure, that has a pretty high multiplier effect and is a pretty good thing. But depending upon what the money gets spent on, the fiscal multipliers can be different. From an investor's perspective, as a starting point, a transition away from monetary only to a mix of monetary and fiscal is a good thing. We still think that there's room for bank valuations to rise in an environment of less regulation and a steeper yield curve. And we think that once the dust settles on the restructuring of the Affordable Care Act, we think there's going to be some opportunities perhaps in insurers and biotech. Other sector things to be paying attention to here would be increases in anything related to energy and infrastructure, particularly if the administration pursues an aggressive plan of deregulation and public-private partnerships in the infrastructure space. Everyone should exercise caution as it relates to bond proxy stocks. We had an amazing run-up in the bond proxies for several years. I'm talking about REITs, utilities, and some of the consumer staples. A bunch of that has unwound now over the last couple months, so we're going to be very cautious on the bond proxy stocks for another year in 2017.